Hi, everybody. My name is Pauline. I drive growth and strategy for a non-custodial crypto exchange service and business suite called ChangeNOW. So, we're dealing with a little bit of a structural lie. We told the world that tokenization was the future, and institutions actually listened, and now we have tokenized everything. A couple of years ago, we had tokenized Lambo steering wheels and a tokenized chair somewhere on a villa in Bali. But a little bit later, since the RWA space actually started maturing a little bit, now we have tokenized treasuries, tokenized equities, tokenized commodities, tokenized private credit funds. But pretty much every single tokenization business is trying to tokenize the exact same thing. So we see people like 15 different issuers are tokenizing oil. Come trade our oil because it's better than those guys' oil. Come trade our unique Apple stock, this time in the form of NFT. No, don't do NFTs. You can purchase a fraction of that on a blockchain that basically is only supported by their own proprietary wallet technology. The result of that is that all of these issuers and all of these institutions, they tokenize and tokenize and tokenize, and then they just sit on those assets because moving capital is actually where the risk lives. A few months ago, a large asset manager came on to us. So they wanted to tokenize a fund, and they wanted to move it across 2 L2s and 1 L1. It would be atomic, compliant, everything was clear cut, and they had big plans. They were ready to pay quite substantial money for us to do it, but we looked at the setup and then we looked at them, and our verdict was, even though we actually wanted to make money, who doesn't? This is what we are all here for, right? But it would be possible if only we had ignored all of the real world applications. And unfortunately, this is not a market. This is a dead end. So why layer 2? Because do we need more chains? I don't think so. We need execution environments that are fast, cheap, and secure, but connected. Layer 2 as well as rollups and validiums give us the raw materials such as sub-second execution, predictable, low transaction costs, and full on-chain transparency, and L1 provided security. Even I think it was about a week ago, the fine folks from the Ethereum Foundation said that L2s are more about unique features now. Unique doesn't matter if they exist within a vacuum, not being to connect to each other. If we don't connect our L2s, we're not fixing fragmentation. We're just deepening our isolation. And over here, I would like to give a shout out to the folks who are already doing that from QuickSwap. They're building something that's called the aggregated layer or the ag layer, where they're at the very least trying to kind of tackle that problem. But at the same time, we can't really say that there's going to be the RWA chain, just like there wasn't the memecoin chain, although I guess you could say Solana was, Base was too. We can't really have the NFT chain because back when NFTs were being super hyped, everybody tried to do NFTs, just like everybody's trying to do RWAs now. Also, institutions don't really care about which rollup is cooler. And what they actually care about is how do you move value without going crazy, just completely cuckoo bananas. Here's what it looks like in practice. So we need liquidity aggregation, which would route across CEXs, DEXs, L1s, L2s, maybe L3s, L4s, L5s, L15s, whatever. We see that as a routing layer that finds the deepest pool between them and executes without the user ever knowing where it went. RFQ models and deep L2 pools and cross-venue routing, fragmentation becomes invisible, which is kind of the end goal, I think, for a lot of you guys if you're building blockchain services per se and not just building chains. The second one is atomic cross-chain settlement, which would not involve any bridges, any waiting. You've got very smooth interoperability if you settle across chains, even though that's not super realistic. The third part of the real architecture that I think is kind of important to say right now is non-custodial execution, because nobody wants to hand over their keys. And as somebody, again, who works for an instant exchange service, holy hell, people do not want to hand over their keys. If we're talking about retail specifically, but neither do the institutions. They don't want to do it either. So the execution layer must be non-custodial by default. And there wouldn't be any middlemen, there wouldn't be any custody, which have been compromised all over the place, like nobody's business. And the fourth part, which is, I think, more relevant for Europe, but correct me if I'm wrong, I think it's also kind of relevant for the US with the Genius Act and with the Clarity Act, is compliance embedded infrastructure. Everybody keeps saying that the regulator is our enemy, MiCA is BS, nobody wants to submit to MiCA, nobody wants to submit to the SEC, nobody wants to follow the travel rule. But if anything of that is not built into the execution, the regulators will just leave you alone and won't touch it. Compliance isn't a headache. It is the price of entry for the real capital. And let's talk about what this changes. For retail, we could have the perfect combination of TradFi and DeFi, something we could call CDFI, but I don't think that's where it is in fashion right now. That would mean 24-hour trading. That would mean lower limitations for geographies where the certain assets are available. It would mean zero custody. It would mean all of the settlement friction would be gone, starting from fractionalized, tokenized assets and ending with, I don't know, me trying to give my wife a half a stock of Coca-Cola at 3 a.m. because I've had a little bit too much wine. For big institutions, that would mean T+0 settlement, reconciliation costs would drop to zero. And for ecosystems, it would mean the L2 as an entity and not just like a lot of, not even that interoperable chains, a settlement layer where TradFi and DeFi would meet without a fight. But even though I've just painted like a very nice picture for you, there is a certain amount of risks that would involve a lot of technical stuff about L2 to L2 fragmentation, smart contract risk and bridge assumptions, legal enforceability, which would mean that the asset exists on chain and law doesn't know it does. And when that whole construction inevitably rugs, no one would be able to help the victim in any case. And scalability without risk transparency would mean building faster on a broken foundation. And this is something that we already see. Let me do a little bit of an example. I don't know if you've probably been following the market last year when everybody was like jerking off insanely to Bitcoin digital asset treasuries. And then they started to do more treasuries of more assets. And then when things went south, a lot of digital asset treasuries like Metaplanet and a few others just started selling off in bulk. Peter Thiel's favorite Ethereum thing, ETHZilla, ceased existing not so long ago. So basically by New Year's, the entire digital asset treasury shtick was done. And one of the reasons for this talk that I'm doing right now is not to let the RW space kind of follow suit, because the technology is revolutionary. Right now we're standing on a brink of adoption. So That's very good. And just as I was talking about digital asset treasuries, we've also seen that with NFTs, monkey pictures. They were disgusting. I don't know how people bought that and why people bought wasted millions of dollars in an ugly monkey picture, so that you could show it around to your friends. We've also had meme coins. I don't know what that was. I guess since we don't have meme coins now, we have perpetual options, but that's a whole other conversation. We're not touching that. And now RWAs, which are kind of succumbing to the hype part of things at the moment, before actually either dying down or maturing, and we're going to need to see what happens first. And why I personally have quite a lot of trust towards RWAs, because they are not monkey pictures. They are retirement and mortgages and real stable capital. And the last thing is something that all of the other crypto market right now, let's not fool ourselves, we are still in the bear market, and investments into that part of the market are not really viable right now unless you're a cracked day trader who just spends all of their time in front of a computer. Why do that when you can just buy Apple shares or Coca-Cola shares or treasury bonds and stocks and so on and so forth? What we see as a way for RWAs kind of being a very sustainable and having longevity is standardizing messaging between L2s, embedded compliance at execution layer, not wrapper, and we're spotlighting builders. So you're here and you're most likely building something, to shout out to you. But when it comes to CDFI, what I would kind of like to talk about is basically ChangeNOW as a liquidity aggregator is basically doing all of the heavy lifting right now. But then again, this technology isn't going to, I don't want to say that we're not going to have scale, because we will. But at the same time, we've been on the market for 7 years, so we know how to do it. And there are a few things that people don't really need ChangeNOW for. So, for example, trading, right? We're more of an investment platform, or swap a big amount of money into USDT or vice versa, and without collapsing the order book. But at the same time, we do believe that on the market, especially in the Ethereum space, there would be somebody who is going to do basically the very same thing, but more into the DeFi direction. Because we tokenize the world and now we need to move it somehow. Layer 2, at least we hope and we believe, is going to be global atomic and compliant settlement. I do have hope that atomic is going to be a relevant word at this point. So let's together build the roads that move the future, which is a very, it might sound like an empty platitudinous phrase, but at the same time, I am angry, and I have started this chat while being angry at a lot of things and in a lot of places, actually. But I hope that anger is going to make you do something, is going to inspire you to do something, because if you're not angry, you will not succeed, basically. You don't have to be evil, but a healthy dose of anger is something that you are going to need in the future, because boring, and it's easy to become angry at being bored, is going to be what scales, and is going to be what institutions are going to trust. And I hope that next time we meet, you're gonna talk to me and be like, Pauline, you were very boring, but you were right. So I hope that happens. Thank you so much for listening to me. I hope you've had a grand old time. And yeah, see you around. I'm going to be on a panel at Builders Night tonight about agentic payments. And this was just a preview for me being angry. I am pissed at AI agents, so feel free to come on in and listen in a little bit. Thank you so much.